Ladies and gentlemen, this afternoon, we've got Avi Gilbert, who is the founder of ElliotWaveTrader.net and a market analyst and author of ElliotWaveTrader.net, a live trading room featuring analysis by him in a dynamic community of professional traders. Mr. Gilbert's Elliott Wave analysis appears frequently on sites such as The Street, MarketWatch, Forbes, and Seeking Alpha. We've also got Garrett Patton, who is the senior analyst of the U.S. equities and U.S. and world indices at ElliotWaveTrader.net and is the chief educator as well, a live trading room featuring Elliott Wave analysis on market stocks. The articles and analysis from Elliott Wave Trader appear regularly on Seeking Alpha, TheStreet.com, and MarketWatch. Mr. Patton's focus is primarily on equity futures and demonstrating the capabilities of unconventional technical analysis. Gentlemen, the floor is yours.
Thank you so much, and welcome everybody. This is Avi Gilbert. I am going to provide a little introduction as to what we're going to be doing today, and then I will be handing the ball off to Garrett. So whereas I know most of you, if not all of you, come to the market with an expectation and a view primarily on market fundamentals or economic news, or some of you even for political news as to what drives the market. But I will say that over the last 30 to 40 years, a lot of market studies have been conducted that have been evidencing the need to move away from those type of models. As an example, there was a study done that was entitled "What Moves Stock Prices?" And in that study, it was a comprehensive study that was one of the people you probably know is Larry Summers, who was involved in that study. But what that study did was they were looking to develop a model through which they would be able to predict market moves retrospectively. You heard me right on that. They weren't even ready yet to start a model to develop for prospective predictions. But what they encountered during this study was very shocking to them. I'll give you some quotes. The study concluded, and I'll quote, "Macroeconomic news explains only about 1/5 of the movements in stock market prices." Another quote they gave us that they even noted that, quote, "Many of the largest market movements in recent history have occurred on days when there were no major news events." They also concluded that, in quotes, "There is surprisingly small effect from big news of political developments and international events." And towards the end, they concluded that the relatively small market responses to such news, along with evidence that large market moves often occur on days without any identifiable major news releases, casts doubt on the view that stock price movements are fully explicable by news. So, the question then we have to ask ourselves is, what then drives stock prices and stock market prices in the global perspective? And about almost 100 years ago, there was a gentleman named Ralph Nelson Elliott who gave us the answer to that. He took the time to take a step back and look at the market from a very different perspective. He looked at it from a perspective of market sentiment, market psychology. What's the general psychology of the market? How did he figure that out? Well, he identified it through movements in the market within a structure. What he discovered was that the market was fractally based. The markets are based on fractals, and those fractals evidence human sentiment, the general sentiment of the public, whether the public is necessarily bullish or bearish at a certain point in the time. And what it means by when he said the market is fractal is that it is variably self-similar at all different degrees of trend. Now, that sounds really complex. I'm going to try and break it down to you in a very simple perspective. Elliott identified that markets move in 5 wave structures in a primary trend, as you can see up on the chart. Waves 1, 3, and 5 move in the direction of the trend, whereas waves 2 and 4 are counter trend. Now, when we also say that markets are variably self-similar at all different degrees of trend, it means that, for example, waves 1, 3, and 5 also, when you break them down, are comprised of 5-wave structures in and of themselves. As you can see on the chart, wave 1 has 5 waves, wave 3 has 5 waves, and wave 5 has 5 waves. And as you move down into the lower degree fractals, wave 1 within wave 1 will also have 5 waves, and wave 3 within wave 1 will also have 5 waves. That is what he meant by their fractal patterns that are variably self-similar at all different degrees of trend. And that is what gives us an opportunity to be able to identify where markets are topping or bottoming. It provides us with an early warning sign. It provides us with reasonable expectations. And Elliott does something that I've seen of no other analysis methodology. And that is, it provides context to the market. So whereas, one of the biggest comments I hear from investors is, well, I may know where to buy, but I don't know where to sell, or I don't know where should I be buying, during this pullback, and so on and so forth. And the Elliott wave structure gives you a perspective and context to answer a lot of those questions from a probabilistic standpoint. So I basically just gave you the general perspective of what Elliott presented us with almost 100 years ago. And what we've done over at Elliott Wave Trader is we've taken that basic methodology and we've provided an even more objective framework to overlay that methodology that Elliott gave us. And it provides us with some extraordinarily accurate turning points. And many of you that followed us over the last decade or more that we've been providing public analysis know that some of our market calls have been quite shocking because of the nature of where the market was at the time and how everybody else was viewing it. And it all really rests upon the basic structure that Elliott gave us almost 100 years ago. So I'm going to bid you all a good day, and I'm going to hand the rest of the presentation over to Garrett. So please leave your questions to the end, and should Garrett have some time at the end, I'm sure he will get to some of your questions. Have a wonderful day, and thank you so much for joining us today. Garrett, it's all yours.
Thank you very much, Avi. All right, so after that introduction that Avi gave you on some of the basics of Elliott wave principle, we're going to get into actual charts in a second here. But before doing so, I just want to go over a few other things that we look for when using Elliott wave analysis. And one of those things is the guideline of alternation. And the reason that I'm discussing this now is because it's going to be pertinent to when we're looking at the SPX chart. But what we tend to see more often than not is during those corrective phases within a trending move, that 5-wave structure to the upside, the wave 2 and 4 tend to alternate in both duration and size. And more often than not, the wave 2 is going to be the shorter duration, sharper correction that doesn't take nearly as long compared to the 4th wave that tends to drag out a lot longer in duration and not really complete in the same quick manner that we see a wave 2 typically complete. So when we are approaching an impulse and we think we have a 1-2 in place and we see that wave 2 develop as a quick, sharp correction, then we can use that guideline of alternation to anticipate that the 4th wave is going to take much longer in duration and drag out, at least probably double the duration that we saw for the wave 2. Another thing that I want to note regarding Elliott wave theory is the difference between the way those 5-wave structures can fill out. We have both an impulsive and a diagonal structure that can result in that 5-wave move to progress price in the direction of the larger trend. The impulse, as the name suggests, is a much more strong move in comparison to the diagonal. The diagonal makes those 5 waves in a much more labored and choppy overlapping fashion compared to an impulse. And diagonal structures appear in either a leading or ending variety. So leading suggesting it's the beginning of a move. So as a wave one of a larger impulse can be a leading diagonal, and an ending diagonal should be at the end of a move. So a fifth wave within an impulse can be an ending diagonal as well. You can kind of see that drawn up here on this next chart. So wave one, possible to take shape as leading diagonal, fifth wave, ending diagonal, as both those names suggest. So just wanted to quickly go over those two things before we take a look at the SPX chart. So let me switch my screen to that. So hopefully you guys can see the S&P 500 index. This is a 3-month chart pulled up on the screen now. And this kind of gives you a big picture view of the entire market, going back to pretty much as far as much possible market data is available. And this even is using some adjusted data that existed prior to when the S&P 500 formed in the early 1900s. And just based on some of those larger cap companies that were otherwise trading before then. The thing that's important to note here is the same larger 5-wave structure, and it might be easier to see if we remove some of that analysis, but you can kind of see a similar shape unfolding here going all the way back to the mid 1800s when price bottomed in 1857. That it is filling out that larger impulsive structure to the upside as a trending 5-wave Elliott wave structure. So during the early 1800s, it was a fairly chaotic time period for both the US and the rest of the world. A period of worsening sentiment and social mood overall. Europe was entangled in the Napoleonic Wars and had been at war practically the entire century prior. The US was still emerging from the Revolutionary War and declared war on the British again in 1812. Industrial revolution was in full swing, and people were starting to transition from rural living to urban living, and that caused further rift between the North and the South. Westward expansion began after the Louisiana Purchase, which led to numerous wars with indigenous tribes. Territories were being drawn and states were being formed, which led to further conflicts, such as the Mexican-American War. And tensions between the Union and the Confederate South ultimately culminated in the Civil War between 1860 and 1869. And the Civil War is what really marked a turning point in sentiment during that century. That is where we see the bottom as far as the overall price history that we have for the stock market in the United States. So a bottom in our economy, again, about mid 1800, 1857 is when that bottom was actually struck. And from there, things slowly started to improve and the stock market began to make progress higher, albeit in a labored and choppy fashion as that leading diagonal. That's why I wanted to show you those two variations of motive waves, a leading diagonal and an impulse. So the initial wave one, you can see here filling out as that more choppy, overlapping leading diagonal structure to fill out those 5 waves up for that larger wave one. And again, remember that fractal nature of markets that Avi was discussing when we were looking at that chart from earlier. There was still a major conflict during the 4th wave of that leading diagonal, which was World War I, but it did lead to the first euphoric phase that our markets had experienced during the Roaring 20s, and ultimately turning into that parabolic top in 1929, which then snapped back just as violently in what is still the worst crash in our market history, which resulted in the Great Depression, which marked the bottom of the supercycle wave 2 here. The economic destruction at the time was worldwide, and it's what kind of set the stage for World War II. But it was also at this time that the man who discovered Elliott wave principle, Ralph Nelson Elliott, forecasted a multi-decade bull market that he believed would culminate in 2012. And if you think back to that time, how just terrible things were, World War II was just about to start. And, the Great Depression was pretty much ravaging worlds and economies overall. It was quite an incredible prognostication to make at the time that we were about to embark in this multi-decade bull market that ultimately lasted at least 60 years until we topped in 2000 here. So his guess of that bull market culminating in 2012 actually wasn't too far off overall, and one of the most impressive stock market calls that I've seen personally. And what he was looking at the time was the move up off of that Great Depression low, the 1932 low, as a 5-wave structure for wave 1 start to that larger impulse, and then that 3-wave corrective pullback as that wave 2. So he recognized the start to that impulse, that 1-2 forming, which was why he was able to predict that it would be setting up a multi-decade bull market that ultimately would compound price many times over. So we had a relatively peaceful period, except for the Vietnam War and the inflation period during the 70s, the late 60s and 70s. But otherwise, up until the tech bubble in 2000, again, just a period of exponential growth in our economies and in the stock market overall. That is until we hit that top in 2000, another euphoric blow-off top stage in our market that resulted in the next corrective 4th wave here that then completed into the 2009 low. And then that brings us to a more familiar time in history here, the bull market that has been ongoing since that low that was struck in 2009. So again, that fractal nature of markets suggests that the 4th wave that completed at that 2009 low should be followed by a 5-wave structure as a 5th wave. And you can see that drawn up on my chart here. 5 waves up from that 2009 low, looking very close to completing. We still anticipate one more higher high in this market as wave 5 of 5 to complete the full 5-wave structure up from that 2009 low, especially as long as price can hold above the low that was made in June, is where ideally wave 4 of that primary wave 5 completed, that primary wave 5 beginning from the 2020 low. So as long as we continue to hold the June low, again, this looks set up for one more final high to complete 5 waves up from the 2020 low as our primary 5th wave. But once that higher high is reached, that will have likely satisfied the full larger 5-wave structure, the impulse off the 2009 low, which within the context of the larger degree big picture count here fits well as the cycle degree wave 5 of the super cycle wave 3. So the entire move up as a 3rd wave from that Great Depression 1932 low, completing potentially after one more higher high in the market. And that brings me back to that guideline of alternation. So assuming this count is correct, the next high in the market completes that super cycle wave 3. The wave 2 at the same degree, super cycle degree here, into that Great Depression 1932 low, filled out as a very sharp, quick, violent correction that we refer to as zigzag in Elliott wave theory. That would suggest to us, based on the rule of alternation, that we should expect the opposite from wave 4, a much longer, drawn out, choppier move that can take, based on just a 3-year correction for that Great Depression move into the super cycle wave 2, more likely than not, potential multi-decade correction for the super cycle wave 4, which isn't going to be just one sharp move to the downside. There's going to be a lot of back and forth, more likely because of that guideline of alternation. So we could see an initial drop lower in an A wave that takes us, potentially all the way back to the low that was made in March of 2020, and then potentially a B wave that could even make a new higher high above the high that was made, or that potentially will be made to finish off this primary wave 5. B waves within a correction can actually make higher highs. It's what is called an expanded flat structure. So it's probably going to be a period of a lot of volatility, a lot of back and forth whipsaw that is more likely than not going to be difficult to trade, especially if you're not necessarily expecting that volatility going into that period of time. But it definitely puts us on alert to be very cautious in how we approach the market, especially if price is able to turn back up from here and get that one more higher high. And I do want to mention that there is risk if price otherwise rolls back over below the June low, that all of that primary wave 5 has already completed at the January high that was struck at the beginning of this year. And we don't see one more higher high as that fifth wave. But even within that scenario, I think we can get a little bit higher here in a corrective B wave bounce before turning back down again to take out that June low. The reason that we are expecting one more higher high to complete that primary wave 5 is because the subwave structure, again, that fractal nature of markets where we should expect the primary fifth off of the 2020 low, really doesn't clearly count as complete as a full 5 waves up yet. There are certain charts where you can definitely get there. It's easier to come to that conclusion when looking at the NASDAQ 100. There is the potential that we do see a higher high in the S&P 500 and maybe a decent sized rally in the NASDAQ, but potentially a lower high struck there. Even individual sectors, and I'll get to that in a second here, also may not be setting up another higher high in that fifth wave. So let's take a look at some of those sectors. Some of the individual sectors that are very much supportive of a higher high still being seen into next year before that primary fifth off the 2020 low completes would be XLV. Another situation, especially holding above that June low, and that is the more likely outcome at the moment, starting that wave 5 of the primary fifth to take us to one more high going into next year, complete that structure off the 2020 low, as well as off of the 2009 low, the large degree 5 waves up, similar to the S&P 500. Another sector that looks set up well for another higher high is XLP. Consumer staples, similar situation, holding above the June low. And that continues to favor that another higher high next year is the wave 5 of primary wave 5 should be seen, but similar situation, any break back below that June low opens the door to all of that primary wave 5 complete. So it's going to be an important pivot level for the market overall in a lot of individual sectors. Real estate is supportive of another push higher as well. The structure into the January high doesn't clearly count as 5 waves up already complete. So as long as price continues to turn up from the June low, we should still see one more higher high there. XLU as well, utilities do support, especially above the June low, that we should see one more higher high into next year as a fifth wave before completing the larger primary fifth overall. XLI industrial sector, similar situation. Want to see a little bit more in this case off of the July low. This made a marginally lower low in July compared to the June low. But especially if price can continue to turn up from that July low, looks very reasonably set up for another high as well to finish off the primary fifth off of the 2020 low. And finally, semiconductor stocks, a little bit deeper than we typically look for a fourth wave here. But as long as the July low is holding, similar situation should be set up for one more higher high as that wave 5 of 5. And some of the individual semiconductor stocks didn't quite get as deep of a fourth wave. They're still within the standard fib support that we expect a fourth wave to hold, such as AMD and NVIDIA. In contrast, there are specific sectors that don't clearly look set up for a higher high. XLK is one of those sectors that can count as 5 waves up complete into the December high from last year, and maybe only setting up a corrective bounce that will ultimately print a lower high in comparison to that December high. XRT, retail, another chart that isn't really as clearly setting up a higher high as wave 5 and potentially topped already at the November high, but also has room to at least participate in some near-term upside in a corrective B wave bounce that, again, may not end up printing a higher high. XLP as well, XLY. Isn't as clearly setting up a higher high. In this case, it is more reasonable to count 5 waves up into the November high complete and just more of a corrective B wave bounce that does not reach a higher high. XHB, home builders, not as clearly setting up. I wouldn't dismiss a higher high here, but compared to some of the earlier sector ETFs that I was discussing, just a lower probability that a higher high is made there. And despite XLV, healthcare sector looking very clearly set up for a higher high, biotechs in particular seem to be just setting up more of a corrective near-term bounce. Despite their strength, outperformance so far in this move up from the recent lows. So that leaves us with 5 minutes for any questions that you guys may have.
All right, wonderful presentation. We have a few questions here. The first question is, will the Dow still make 5500? 5,500.
The potential for a higher high, I think, is reasonable on the Dow Jones as well. But I'm not sure it'll reach 55,000. Looking at maybe 40-ish that could be reached before that fifth wave completes. So looking for 55,000 is a little bit optimistic in my opinion.
All right, next question is, precious metals went down in the last few months. Will they be up again even if we move into a recession?
More equity focused for this webinar, but just to comment on precious metals, I wouldn't necessarily be trying to use economic situations or expectations, news, as Avi was discussing, as clues to anticipate where price is going to be going. Both gold and silver can be nearing a correction down from either the 2020 high in the case of gold or the high made last year in the case of silver, but both have not provided enough evidence yet that that bottom is clearly in place.
All right, we have another question, which is, what are your thoughts on oil and energy?
Both different sectors. Let's take a look at XLE. XLE does look set up for further upside next year. However, less clearly directly from here. The move down, we're dealing with a similar five-wave structure off of the 2020 low, but obviously different looking chart in comparison to the broader market and the rest of equities. In this case, it looks like the third within that five-wave structure completed at the recent June high. This is only wave A of 4 so far, working on a corrective B wave bounce to be followed by wave C of 4. And then after that deeper fourth wave pullback, next year we see another high as wave 5, even potentially into 2020, late 2023.
All right, our next question is, what should we invest in after the fifth wave is complete?
Obviously, there will be some shorting opportunities and plenty of downside opportunities, assuming that large degree correction in place. The overall expectation for that fourth wave, as I was discussing, based on that guideline of alternation compared to that sharp, violent correction into the Great Depression low, would be a lot more choppy and volatile. So there's going to be a lot of back and forth opportunities that for investors may be a nightmare, but for nimble traders could be a great time to be compounding portfolios with that violent back and forth that we see. There are other markets, of course, that we can look at. For example, the US dollar, I think, is primed to set up a multi-decade rally overall. Not necessarily directly, we could see some initial downside following a similar higher high into next year here to complete this wave 1, but that looks like a much larger wave 1 off of the 2008 lows, a little bit different in that respect. So an opportunity after this wave 2 pullback, but that's, several years down the road. Commodities in general, a lot of them look like they have put in a bottom to a correction off of the highs that were made in 2008 into that 2020 low. Many of them sporting 5 waves up from the low. So if you look at DBC and DBA, 5 waves up from that 2020 low can be a larger primary wave 1. We pull back in a corrective wave 2 or more of this wave 4, following something a little bit more in line with energy stocks. Then there's some opportunities there as well.
All right. And we've got time for one more question, and that is, why is the June low your critical S&P wave 4 support level and not the 2020 wave high at 3,500? I'm not sure if that came across clear enough.
So yeah, he sounds like he's familiar with Elliott wave theory, in that within an impulsive structure, one of the rules is wave 4 cannot enter into the price territory of wave one. You can't see overlap. Otherwise, that invalidates that being an impulse. So this wave one high is technically where the wave four would invalidate, but just from a probability standpoint, we typically look for a fourth wave to complete between a 382 and 50% retrace of the wave three. So dipping a little bit below that 50% closer to the 618 was already a little bit deeper than ideal for the wave four. It does fit the guideline of alternation though. We had a very sharp, quick wave two in 2020, and then a much more drawn out, deeper wave four recently into that June low. But again, from a probability standpoint, I think we have a much cleaner setup for a higher high as long as the June low holds. I think it's a big dent in the probability that we do see a higher high if that low breaks.
All right. Thank you very much, Garrett. We are at time. So thanks to our attendees, and we've got more content coming up. We will see you on the next one.
Thank you very much.